Welcome to this explainer on why 90% of traders never become consistently profitable and how you can actually build a real edge. If you've ever felt that absolute gut punch of watching a winning trade instantly reverse on you, yeah, you know exactly how unforgiving the markets can be. Today, we're not just throwing numbers at you. We're going to break down the actual framework that separates the people who survive in the markets from the ones who just drain their accounts. Let's dive right in. So, why do 90% of traders fail? You know the story. Most people spend literally years searching for the holy grail of trading. They're hunting for that perfect indicator, the flawless setup, or that one ultimate stock. They pour thousands of hours into watching tutorials, joining online forums, and just obsessively analyzing charts. And yet, despite all this relentless effort, and honestly, having access to more information than at any other point in human history, the vast majority still end up losing their capital.
90%. That's just a massive failure rate. We are talking about incredibly intelligent, hardworking people here. Engineers, doctors, business owners, people who apply their pretty formidable intellects to the market and still come up short. Heck, even elite Wall Street algorithms sometimes blow up multi-million-dollar accounts in a matter of seconds. If intelligence and hard work were the only things you needed, that failure rate wouldn't be anywhere near 90%. So what's the invisible barrier keeping all these smart people from becoming consistently profitable? Well, the source material hits us with a pretty staggering truth. It's not the strategy. Finding a profitable setup is absolutely not the missing link here. In fact, a lot of traders who are using historically proven, highly profitable strategies still manage to consistently lose money. Crazy, right? If the strategy itself is mathematically sound, but the trader is still bleeding capital, well, the root cause of the failure has almost nothing to do with the market itself. It has everything to do with the human operating the system.
Section 1. The harsh reality, the cycle of doom.
Okay, picture this. Two traders start out with the exact same capital and identical market access. They read the exact same news, analyze the exact same price action. Trader A, they relentlessly strategy hop, they overtrade, and they make snap emotional decisions. Meanwhile, Trader B relies entirely on a structured process, rigorous journaling, and systematic trade reviews. Fast forward, and Trader B survives and actually scales their account, while Trader A repeatedly gets wiped out. Most people assume the answer to their trading woes is just acquiring more knowledge, but honestly, it's really about the behavioral structure they build around the knowledge they already have.
And here is where Trader A falls right into the trap. We call it the cycle of doom. It starts simply enough, right? A trader takes a few unexpected losses. Those losses create fear. That fear leads to impulsive decisions, doubling down, widening a stop loss, or just abandoning the trading plan entirely. It's a dark cycle, and it's highly relatable for anyone who's ever found themselves staring red-eyed at a 1-minute chart at 3 a.m., desperately hoping a coin will bounce. Those impulsive decisions inevitably create even larger losses. The trader panics, assumes their strategy is broken, jumps to a new guru, and the whole cycle reboots before the strategy ever actually has the time to mathematically prove itself.
Section 2. What is a trading edge? Look, we've got to debunk a massive misconception right out of the gate. Having an edge absolutely does not mean winning every trade. When people picture a successful trader, they usually imagine this Wall Street wizard perfectly predicting the market 100% of the time. That is pure fiction. No way that happens. Some of the greatest quantitative hedge fund managers in the world, people managing billions of dollars, lose nearly half their trades. They are wrong almost 50% of the time, yet they remain massively, massively profitable. So if they aren't right all the time, what exactly do they have? Well, a true trading edge is simply a repeatable process that produces a positive expectation over a large number of trades. Consistency is what separates the amateurs from the professionals, not accuracy, consistency. The market absolutely does not reward you for being right on one single, lucky, heavily leveraged trade. It rewards a systematic process that works repeatedly over a series of hundreds of trades. Think of it like a simple coin toss. But in this version of the game, every time the coin lands on your chosen side, you win 200 rupees. Every time you're wrong, you only lose 100 rupees. Do you need to win every single coin toss to make money? Absolutely not. You could be wrong half the time, or honestly even slightly more than half the time, and you would still come out ahead mathematically. Your risk versus your reward creates an asymmetric payoff. And that is exactly how a real trading edge functions out there in the financial markets. There's a quote that perfectly captures this. Amateurs think in predictions. Professionals think in probabilities. That single mindset shift, it changes absolutely everything. An amateur takes a loss personally. They view it as this humiliating failure of their predictive abilities. A professional, they just accept a loss as a standard business expense. It's just a statistical inevitability within their larger probabilistic model. They don't try to predict the future. They just execute their edge over and over again. Section 3. The 4 pillars of success. All right, so we know what an edge is now, but just having a profitable strategy alone? Yeah, still not enough. To actually maintain an edge in a live, highly stressful environment, you need a structural foundation built on 4 pillars. Pillar 1 is psychology, managing those emotional impulses, the greed and the fear. Pillar 2 is risk management, protecting your capital so a single black swan event doesn't wipe you off the map. Pillar 3 is strategy, the actual rules of your edge, dictating exactly when to enter and exit. And Pillar 4, which is so often ignored, is performance tracking, the meticulous data collection of your own actions. All 4 of these literally have to be flawlessly integrated. Because here is the scary part. If just one of these pillars breaks, the entire system collapses. It's a pretty sobering thought. You could have world-class psychology, brilliant risk management, and flawless performance tracking, but if you're running a strategy with a negative mathematical expectation, you are going to slowly bleed to death. On the flip side, you could have the greatest strategy in the world, but if your risk management breaks down and you bet your entire account margin on one trade, you lose everything. Every single pillar carries the entire weight of your success. Section 4. The professional feedback loop. You see, when amateurs hit a bad trade, they instantly want to change their strategy. But think about other high-performance pros for a second. Would a commercial pilot completely change their landing procedures just because they hit some turbulence? Would an Olympic athlete fire their coach and rewrite their entire training regimen after one bad game? Would Formula One engineers redesign the whole car without meticulously studying the telemetry data? Of course not. Professionals review the data. Amateurs, they act on pure, unfiltered emotion. This right here is the continuous cyclical learning system that professionals use to actually build that consistency. It's an unyielding feedback loop. Step 1, execute the trade according to the plan. Step 2, record the data meticulously in a trade journal. Step 3, review that performance over a meaningful sample size. And Step 4, refine the edge based on empirical data, not feelings. This is how you stop guessing and actually start mechanically engineering your success. So, I want to turn this over to you for a second. Looking at all these elements, what is your biggest challenge right now? Is it your psychology and dealing with the fear of missing out? Is it risk management and reckless position sizing? Is it finding a strategy with a true statistical edge? Or is it simply consistency, staying disciplined enough to execute your plan every single day? Identifying your weakest pillar is the absolutely crucial first step toward reinforcing it. I want to leave you with this final thought. Success in trading is not about predicting the future, it's about building a process that survives it. You cannot control what the market is going to do tomorrow, but you can absolutely control your process, your risk, and your reactions. So ask yourself, the next time you fire up your trading platform, are you going to gamble, or are you going to execute a system that survives? Thanks for joining us for this explainer, and I hope this gives you the tools to start building a real edge.